What if I told you that owning SCHD, yes, the dividend darling everyone loves, might be setting you up for comfortably average instead of financially free? That's not clickbait. That's a hard truth I had to learn the long way. You see, for years I thought I was doing everything right. SCHD gave me consistent dividends, low fees, exposure to safe companies, but then I ran the numbers and I saw what I'd missed, not just a few $100, but six figures in potential growth. Just by stopping at SCHD and not pairing it with two specific ETFs that fill in its blind spots. That moment wrecked me because I wasn't just losing money, I was losing time. I was stuck in the dividend death trap, collecting crumbs now while watching my future freedom shrink every year. Here's what nobody tells you. SCHD is great, but it's not complete. It's missing exposure to the explosive sectors driving today's market, like tech, AI, and next-gen innovation, and it's not optimized for real income either. In this video, I'll show you exactly how to fix that. You'll learn the two ETFs that, when combined with SCHD, can completely transform your strategy. One for long-term wealth builders and one for serious income seekers. By the end, you'll not only see the difference, you'll feel it. Because this isn't about theory, it's about freedom and choosing the right path before it's too late. Stick around. You're about to unlock the playbook most investors never get to see. Let's talk about why everyone loves SCHD so much. SCHD is popular for a reason, and honestly, for many investors, it's been the gold standard of dividend ETFs. It gives you instant access to some of the most reliable, high-quality companies in the US, the kind that have stood through market cycles, economic shifts, and even recessions without flinching. We're talking about dividend-paying beasts like Pepsi, Coca-Cola, Merck, and Lockheed Martin. These aren't hype stocks, they're cash flow machines. What makes SCHD so attractive is its focus on quality. It doesn't just buy any company that pays a dividend. It filters for real financial strength, high return on equity, consistent earnings, strong cash flow, and 5 years of growing dividends. That's a moat most funds don't bother building. And it's huge. As of October 2025, SCHD manages over $70 billion in assets. Its dividend yield is a solid 3.87%, and it's only getting better. In 2021, the quarterly payout was around 17 cents. In 2025, it's hitting 26 cents per share. That's serious growth. Even better, you get all of this for practically nothing. The expense ratio is just 0.06%. That's $6 a year for every $10,000 invested. It's like getting a full-time money manager for the cost of a coffee. So, it's no wonder SCHD is trusted. It's safe, stable, proven. The foundation of a long-term portfolio that pays you to wait. But here's the uncomfortable truth most people never stop to consider. But here's the part no one ever tells you about it. SCHD is safe, it's dependable, but it's also dangerously incomplete. Why? Because while it keeps you protected, it doesn't give you the offense you need to actually win in today's market. Let me ask you this. How much of SCHD is exposed to the industries that are dominating modern innovation? Tech, AI, cloud computing, semiconductors. Just 8.3%. That's it. The same sector that's driving the most explosive gains in the S&P 500, the same companies building the future, barely show up in your SCHD portfolio. And the impact of that is brutal. Through September 2025, SCHD is up just 2.84% for the year. That's fine, until you look around and realize the broader market crushed that with its value category alone up over 11%. Zoom out to a one-year return, SCHD delivered just 0.56%, almost flat. And here's the part that stings. It's not that SCHD is broken. It's doing what it's supposed to do. But if you're only holding SCHD, you're playing a one-sided game. It's like showing up to a championship with only a defense. No offense, no playmakers, no ability to score. You're not investing for freedom. You're investing not to lose. And that's exactly where most people get stuck. In comfort, in protection, in low-growth purgatory. But you don't have to stay there, because there's a way to fix it. Why? And it starts with pairing SCHD with the right ETF to unlock the potential it's missing. And that's what we're diving into next. Okay, now if you want to build serious wealth, listen to this. So if SCHD gives you the defense, what gives you the offense? The answer is SCHG, the Schwab US Large Cap Growth ETF. And this is where the game completely changes. SCHG is built to capture the future. It's packed with companies that are driving the most powerful trends in the market. AI, cloud infrastructure, digital payments, advanced chips. The sector's creating generational wealth right now. What makes SCHG the perfect complement to SCHD is that these two funds have zero overlap, not a single stock by weight. That means every dollar you invest in SCHG brings you new exposure, not duplication. And that's rare. While SCHD focuses on high dividend value heavy names, SCHG is pure growth. Its top holdings include Nvidia, Microsoft, Apple, Amazon, Tesla, Meta, Alphabet, and Broadcom. The very companies that have driven the majority of the market's returns in recent years. And the numbers don't lie. Year to date through September 2025, SCHG is up 14.84%. 1 year return? A whopping 23%. Its 3-year annualized return is 32%. Long term, since its inception in 2009, SCHG has averaged nearly 17% a year. Now let's zoom out. If you had simply split your money 50-50 between SCHD and SCHG and rebalanced once a year, a $10,000 investment over the past 14 years would have grown to over $556,000. That's not just beating the market, that's crushing it. The S&P 500 over that same period would have landed you around $534,000. And remember, this combo still gave you a 2.1% dividend yield, way higher than the S&P's current 1.3%. Here's the dream scenario. If you're in your 20s or 30s, putting in just $300 a month with a $2,000 starting investment into a 50-50 SCHD and SCHG portfolio and reinvesting dividends, you could realistically hit $1 million in 25 to 30 years. But wait, here's what you need to know before you jump in. Now let's be real. SCHG isn't magic, and it's not without risk. This fund is a roller coaster compared to SCHD. Its volatility is higher, like 16.3% standard deviation versus SCHD's 14.5%. That means when tech stocks drop, and they will, SCHG takes a bigger hit. You're also exposed to a very concentrated list of mega cap stocks. The Magnificent Seven, Nvidia, Apple, Microsoft, Meta, Amazon, Google, Tesla, make up over half the fund's weight. If even a couple of those names stumble, your portfolio will feel it. Then there's valuation. SCHG is currently trading at a price-to-earnings ratio over 39 and a price-to-book above 10. These are expensive companies, and if the market shifts or rates spike, those valuations can compress hard. But here's the perspective most people miss. Volatility is the price of admission for long-term reward. It's what you endure to unlock exponential growth. And if you've got a 10-plus year time horizon and a strong stomach for short-term swings, SCHG paired with SCHD could be the smartest two-fund combo in the market. You get defensive dividend strength, explosive growth upside, minimal overlap, and rock-bottom fees. 0.04% for SCHG and 0.06% for SCHD. That's practically free. This is the path for those of you who aren't just trying to retire. You're trying to build real wealth and buy your freedom. Now, if that sounds too aggressive for where you're at in life, don't worry, because the next path is designed for the exact opposite goal. Now, if you're all about cash flow, this next part is for you. Now, not everyone watching this is chasing growth. Some of you are entering retirement, or close to it. Maybe you're building passive income to leave your 9-to-5, or maybe you just want money now, showing up in your account every single month. If that's you, then JEPI might be the missing piece you've been looking for. JEPI, short for JP Morgan Equity Premium Income ETF, is designed with a totally different goal than SCHG. This fund doesn't try to beat the market. It's not chasing growth. Instead, it's laser-focused on generating high, consistent income. Here's how it works. JEPI uses a dual strategy. About 80 to 90% of the fund is invested in large-cap U.S. stocks. Companies like Microsoft, Meta, Visa, Johnson & Johnson, and Nvidia. High-quality, low-volatility names that form a solid defensive core. Then the magic happens in the other 10 to 20%. JEPI writes covered calls, selling options on the S&P 500 to generate premium income. Think of it like collecting rent from the market. You cap some of your upside, but in return, you get paid up front every month. And those payments, they're no joke. JEPI's current yield sits between 7% and 8%, depending on market conditions. On a $100,000 portfolio, that's $5,500 to $6,000 per year in dividend income. And it's paid out monthly. For income-focused investors, that's a game changer. You're not just watching your account value grow slowly over time. You're getting real spendable cash in your pocket every single month. That can cover bills, replace a paycheck, or fast-track your path to financial independence. If you're nearing retirement, living off dividends, or pursuing FIRE, the financial independence retire early lifestyle. This combo of SCHD plus JEPI could be the most practical strategy you ever build. But there are trade-offs you need to know. But JEPI isn't perfect. Here's what you have to consider. JEPI might sound like the perfect income machine, but let's talk honestly about what you're giving up. First, the upside is capped. Because of the covered call strategy, JEPI limits its gains in strong bull markets. When growth stocks are surging 20 to 30%, JEPI might grind out a solid 5 to 7%, but you'll miss the fireworks. Second, there's tax complexity. Unlike SCHD or SCHG, JEPI's distributions are a mix of qualified dividends, non-qualified income, and return of capital. That creates a messier tax situation in taxable accounts. More paperwork, more planning. In retirement accounts like IRAs or 401ks, it doesn't matter. But for taxable portfolios, it's something to consider. And third, JEPI just isn't built for maximum long-term growth. Over the past few years, its total return has lagged behind SCHD and SCHG. That's not a failure. It's by design. This is a cash flow tool, not a wealth rocket. So when does JEPI make perfect sense? When your priority is income now, not growth later. When you want lower volatility, even if it means missing out on market highs. When you're focused on stability, consistency, and monthly checks over 10 times returns. Or when you're building a portfolio that supplements or replaces your day job income. And here's where it gets really interesting. You don't have to choose one path or the other. A balanced approach holding SCHD, SCHG, and JEPI in different ratios based on your goals gives you flexibility. You can dial up growth or income, reinvest in your 30s, withdraw in your 60s. You control the throttle. What matters most is building a strategy that fits your life, not someone else's. All right, so what's the right move for you? All right, we've broken down the two strategies. Now comes the big question. SCHD plus SCHG or SCHD plus JEPI. Let's make it simple. If you're chasing long-term wealth, want exposure to tech, AI, and growth sectors, and can stomach short-term volatility, go with SCHD plus SCHG. It's the power combo for building a 1 million plus portfolio over time. But if you need income now, want monthly cash hitting your account, and prefer a more stable ride, SCHD plus JEPI is your move. This is the combo for retirees, passive income seekers, or anyone following the FIRE lifestyle. Here are the real questions to ask yourself. What's your time horizon? Are you building for 20 plus years or drawing income today? What's your goal? Growth, income, or a mix of both? What's your risk tolerance? Can you handle market dips without panicking? This isn't about finding the perfect fund. It's about picking a strategy you can actually stick with through the ups and downs. Because the truth is, consistency beats complexity every single time. Real talk, you've got to start now. If you take nothing else from this video, remember this. Start now. You don't need to have it all figured out. You don't need $10,000 sitting in your account. Even $50 a month not consistently invested into a smart, diversified strategy adds up fast. The biggest mistake most people make isn't buying the wrong ETF. It's sitting on the sidelines waiting for perfect timing. Perfect timing doesn't exist. But smart, consistent investing? That's how you create real options in life. Don't chase hype. Don't panic sell. Don't overthink it. Build slow, smart, steady. Quick question before you go. So now it's your turn. Drop a comment below and let me know. Are you team growth, SCHD plus SCHG, or team income, SCHD plus JEPI? And if this video gave you real value, smash that like button and subscribe to Dividend Hustle. Because every week I break down real investing strategies. No hype, no fluff, just deep, researched, calm content that actually helps you build wealth. This isn't a get-rich-quick scheme. This is how real wealth is built. I'm Mark, and I'll see you in the next one.